Hello and welcome to the lecture for Chapter 11. You may remember in Chapter 10 I talked about ways that we could finance a corporation. In Chapter 10 we talked about long-term debt, primarily bonds. We're going to talk about the other method today, which is equity, issuing stock in the corporation, and the transactions that kind of surround that activity, from issuing stock to paying dividends to our shareholders to reward them for their ownership, and then buying shares back. I'll also finish by talking about one of the most important ratios, which is earnings per share. So over 90% of U.S. business revenues are earned by corporations. So the largest number of entities would be sole proprietorships, but the majority of revenue in the United States is generated by corporations. Until I started teaching, all of the entities that I had worked for in my career had been corporations. The really important thing is, and you may remember this from Accounting 201 or past lectures, is that a corporation is a separate legal entity. So it provides protection to its owners from lawsuits that could presumably go after their personal wealth. It creates a barrier between the assets of the owners of the company and the assets of the company. That's the primary reason that people choose to incorporate, is to have that kind of protection that they can't risk their personal assets. The other benefit of corporations is that it's easier to raise money because you can sell ownership, shares of ownership, which are referred to as stock. So the stockholders of a company are the owners of the company in the proportion to which they hold shares relative to the total. Now, there are different kinds of corporations. The corporations that we both think about and read about in the news, like Tesla and Ford and Microsoft and all of the Apple, all of those kinds of companies, are public corporations, meaning that their shares of ownership, their stock, is available to be bought or sold on stock exchanges. So you could call your stockbroker tomorrow and say, I'd like to buy some Apple shares. I've heard they're coming out with something new. I think the shares will go up. That means they're a publicly traded corporation. There's about 15,000 publicly traded corporations in the United States. They have to jump through a lot of hoops, a lot of legal requirements and oversight requirements, because there's such a strong possibility for fraud. And the government doesn't want particularly unsophisticated investors to be at risk of fraud, losing their money through illegitimate means. The remaining corporations are private corporations, or another term for that is closely held, meaning they're owned by a small number of people. There's about 2 to 3 million of those kinds of corporations in the United States. When I owned my company, Big Toys, my wife and I were the sole shareholders. So nobody else owned stock. You couldn't buy or sell shares of my company on a stock exchange. So we had control over the company. A corporation is a taxable entity, so it files its own tax return, pays its own taxes, and that's one of the downsides, is there is a double taxation issue. Say if my corporation earns $100,000 in net income, we'll file a corporate tax return in 1120, and we'll pay corporate tax on that $100,000 in profit. I think the average, it's about 21% now. So we'll pay 21,000. Well, the 79,000 that's left, if we choose to pay that out to our owners as a dividend, then the owners are also going to pay tax on that 79,000 as dividend income on their personal tax returns. So that's the one downside of corporations, is a slightly heavier tax burden than other options. So stockholders' equity is comprised of paid-in capital. That's money that investors have put into the company for the initial offering of shares. So for the sale of shares to owners, that's paid-in capital. That consists of both accounts like common stock and preferred stock, which we'll record at par, which I'll talk about in a minute, and retained earnings. So the historical profits of the company that have been retained in the company for growth and investment as opposed to shared back with shareholders through dividends. So retained earnings is increased by net income. So revenues pull it up, expenses pull it down, and it's decreased by net losses and dividends. So that's how retained earnings is going to change over time. Now, paid-in capital consists, as I mentioned, of the money we've received for shares. And the number of shares that exist in a corporation is really an important thing to understand. So the largest pool, or the largest circle shown in that diagram there, is the number of shares that are authorized. That's the number of shares that the board of directors has told management you can issue up to this many shares before you come back to us and ask for permission to issue more. So they may authorize the board to issue 1 million shares, as an example. The next circle is the amount of shares that have been issued. Those are the ones that have actually been given to shareholders in return for money or assets that are contributed to the company. In the old days, back when I started, there was actually a book of shares that were physical pieces of paper that you would write the person's name on and tear it off, and there was a stub that you would record how many of these shares went to this person or that person. So those are the ones that have been issued. And then the last category are the ones that are outstanding. Those are the ones that are still owned by shareholders. The difference between issued and outstanding would be the shares that we've repurchased. So the company has bought shares back from its shareholders and the company is holding them. That's the difference between issued and outstanding. Those are called treasury shares or treasury stock, and I'll talk about that shortly. So most states require there to be a par value. It's a somewhat arbitrary value that's placed on stock, and companies are not allowed to issue shares below that value. They're not allowed to pay out dividends below that value in the equity accounts. The reason for that is to protect the interest of debtors, or creditors rather, people that loan the company money. They want to make sure that shareholders don't suck all of the money out of the company, leaving the creditors to hang. So the rights of shareholders, they have the right to vote on corporate matters. Shareholders are the ones that elect the board of directors. The board of directors then appoints the chief executive officer. All of the top positions in the company, the top handful of positions in the company, are elected by the board of directors. There is a right to share in profits through receiving dividends, and a right to a share of the assets should the company be liquidated. So now for some journal entries. So stock is usually issued at a premium, meaning above par. And we're going to talk about examples of how those entries are made when there is par value, because as I mentioned, most states have par value. So in the case where we issued preferred shares, and I'll talk a little bit later about the difference between preferred and common stock, but those are just two classes of stock. So in the first entry there, we issue preferred stock for $50 for $55, and it has a $50 par per share. So we receive $110,000, right? Somebody pays us that much in return for these shares. We're always going to credit the stock account, the preferred stock or common stock, which has a normal credit balance. We're always going to credit that at par. So the entries to those accounts will always be at par value. And then we have a second account that's connected to that, that's kind of right after that on the balance sheet, called paid-in capital in excess of par. And you can see we have one for preferred stock. We would have one for common stock as well. And that's going to get the difference. So we're going to keep track separately of par and the amount paid above par. The second example, somebody's contributing an asset, not cash. They're contributing land in this case. So we would look at what the fair market value of the land is. We would debit the land at that fair market value, and we would credit, in this case, we're issuing shares of common stock, so we credit common stock again at par, and we credit paid-in capital in excess of par, and I would have put common stock after the word par there in that account title. We credit that account for the difference. So again, I mentioned there are two different classes of common stock. Not all companies have two classes. If companies don't have more than one class, then it's all considered to be common stock. The primary difference is preferred stock is going to be, as this graphic shows, they're going to be first in line for dividends. So if dividends are going to be paid, they're paid first to preferred shareholders, then whatever is left over can be paid to common shareholders. Usually preferred stock has some dividend rights associated with it. So the preferred stock will say that it pays $1 a year per share of dividends, or it could say 5% preferred stock. That means it's going to pay 5% of its par value every year for dividends. So it's a more reliable kind of investment if what you're after is dividend income. But it's not as good an investment in terms of appreciation, because if the company has a huge upside, the preferred shareholders are not going to get more than what is prescribed for their shares. Common stock, however, can receive any kind of dividend. So preferred shares with regard to their dividends could also be cumulative or non-cumulative. If it's cumulative, it means if we have a bad year and we miss paying that dividend, we need to keep track of that, and we need to make that up before we pay anybody else the next dividend. So you're always going to be made whole. Non-cumulative means we had a bad year, we couldn't pay the dividend, sorry, forget about it, move on. So it could have those two different kinds of status. So when we account for dividends, the management of the company will go to the board of directors and say, we have sufficient profits, we have sufficient cash, we have sufficient retained earnings, and we recommend the following dividend. So one question to stop and ask is, why would a company willingly take part of their cash and spend it on something that by definition is not productive? We're not buying a new machine, we're not launching a new product, we're not expanding our sales force, we're not doing things to grow the company with that money, we're giving it to the owners. Well, you have to think about who management works for. Management works for, like the tops, the CEO, the CFO, the COO, they work for the board of directors. That's who can fire them or give them a bonus. The board of directors represents the shareholders. So in order for management to keep the board of directors and the shareholders happy, they need to be paying dividends and letting those investors see a return on their investment. So that's what kind of drives that. So the management will go to the board of directors, they'll make a suggestion for what the dividend should be. The board of directors will take that under consideration, review it on their own, and if they agree, they'll authorize the dividend by declaring the dividend. At that date, we're going to record an entry, and I'll talk about those entries in a minute. Those dividends can take the form of cash or stock. So most companies pay a cash dividend. They write checks to the owners of the company. If a company is cash strapped, but they still want to reward their shareholders with something of value, they could also pay the dividend in terms of stock. They could issue more shares of stock that they don't receive payment for and give them to shareholders. So again, retained earnings and cash must be sufficient to allow for that, so we can't drive that account negative. And then 3 dates are important. The date of the declaration, which is when the board of directors authorizes the dividend, that's going to trigger an entry. The date of record, so that's important because that's the date that will say the people who own the shares on this date are the ones that are going to get the check. As you can imagine, a public corporation, people are buying and selling shares all of the time. So you need to have a fixed point where you say, okay, we're going to declare the dividend on October 15th to shareholders of record on October 31st, and we'll pay it on November 15th. So whoever owns the shares on October 31st, they're the ones that are going to get the check. And then the date of payment is just the day we pay the liability. So we'll look at some entries here. So in this case here, the board of directors declares a dividend on October 1st, shareholders of record on November 1st, payment on December 2nd. In this case here, we're going to pay out $42,500 of dividends. You can see how the math is done there between preferred and common. So on the date of declaration, we're going to debit cash dividends. Cash dividends is an account with a normal debit balance, and it's going to reside right beneath retained earnings, which has a normal credit balance. So it's going to offset retained earnings. And we credit cash dividends payable, a current liability like any other liability. So we do this entry on the date of declaration. On the date of record, no entry is required. We're just going to consult our records about share ownership and decide who's going to get what. And the date of payment, we're actually going to cut the checks. So we're going to debit the short-term or current liability and credit cash as we would with any other current liability. At the end of the year, the balance in cash dividends is going to be closed out to retain earnings. So cash dividends is a temporary account. Now, a stock dividend is a little bit different. So it's issuing shares of stock, and in effect, it only affects the equity portion of the balance sheet, and it transfers money from retained earnings to paid-in capital. That's the net effect of that. So in this case here, we assume the board of directors declares a stock dividend of 100,000 shares on December 15th to shareholders of record on December 31st to be distributed on January 10th. We need to take into account the market value of the stock. So the stock has a $20 par and it's currently trading at $31. So $31 times 100,000, that's the value that we're giving to shareholders. They could turn around and sell those shares that day and have cash. So for that entry, when we declare the dividend, we're going to debit stock dividends, which is an account just like cash dividends. Normal debit balance resides in the equity section of the balance sheet. In this case, it would be right next to common stock. And then at year end, we're going to close that out to retain earnings just like we do cash dividends. So once the shares are issued, we've got that placeholder, stock dividends distributable. That's the number of shares times the par value. That's a placeholder until we issue the shares, and then we'll credit common stock and debit this distributable account. So it's just a short-term placeholder. One thing to keep in mind is that if the stock dividend is considered to be small, which is less than 20 or 25% of the total shares of the company, which is usually the case, in those situations, we'll use the market value of the stock. If it's a large stock dividend, so over 20 or 25%, then we'll use par value. So when we distribute the stock, as I mentioned, we'll debit that placeholder account, stock dividend distributable, and we'll credit common stock. That's the reason that we needed to credit stock dividend distributable for par value, is that we're going to swap it out for common stock at a later date. Treasury stock is when a company buys its shares back. The reason that companies buy their shares back is, we'll talk in a minute about earnings per share, a very important figure, but the value of a company is based on the expectations of investors, what they think the future is going to be. It's not based on how much cash is in the bank. So if a company is sitting on excess cash for some reason, they can use that excess cash to buy back some shares from shareholders, which reduces the denominator in coming up with a per share value, right? The per share value of a company, if you look up Apple right now and see what the per share value is, that's the value of the entire company divided by the number of shares that are outstanding. So if you reduce the number of shares outstanding, you increase the share price. If you're a CEO and you're reporting to your board of directors, an increased share price is going to get you a pat on the back and a bonus. So that's kind of why that happens. So treasury stock is a contra account. It has a normal debit balance, and it's found in the stockholders' equity section of the balance sheet. We're required to use the cost method for treasury stock. So when we're dealing with treasury stock, we can forget about par value, and we just record it at the price we pay for it, and we keep track of that. If we sell some later, we record a gain or a loss. So here on, assume February 13th, we purchase 1,000 shares of treasury stock at $45 per share. Now it has $25 par, we can ignore that. So we debit treasury stock, again, that contra account in the equity section, for the amount we paid, and we credit cash. We write a check for it. Now, if we later reissue or sell some of those treasury shares, we're going to debit cash for the cash we receive for the shares. We're going to credit treasury stock, and this is important. We're going to credit treasury stock at the cost that we paid for it. So it's going to go into that account at cost and come out at cost. So if we purchase 1,000 shares and then sell 1,000 shares, that account will zero out. And then you can see we have paid in capital from sale of treasury stock. So that kind of gain never flows through the income statement. The reason for that is they didn't want companies to manipulate their earnings through transactions with their own shares. So that kind of gain is going to be reported as part of paid in capital under the equity section. Now, the last thing I want to mention is earnings per share. So earnings per share is calculated by taking the net income of a company minus the amount paid for preferred dividends and dividing that by the number of common shares outstanding. If there's movement in the number of common shares over the course of the year, we'll calculate a weighted average number of shares by how many days the shares were outstanding during the course of the year. And this is a really important figure that investors track very closely. They will also, although it isn't shown here, they'll use this figure to come up with a price earnings ratio, or PE ratio. That's where they compare the current price of the stock to how much each share earned in terms of net income for the year. So the higher the PE ratio, the more speculative the stock is, the more its value is placed on hopes for the future as opposed to current profit. It's interesting to look at the PE ratio of large car manufacturers. You'll find that Ford and GM are fairly low figures. I believe their PE ratio is under 10. And a company like Tesla that is very future oriented, expected to do great things down the road, their PE ratio is 40 or 50. It's multiple times higher than traditional car companies. So please work through the in-class practice now. I believe there are 3 of them. Check the results of the solution against what you've done, and then work on your homework. As always, if you have any questions, please don't hesitate to email me, and I look forward to talking to you again in Chapter 12's lecture. Thank you.